Hello, hello, hello. Welcome everyone to episode 17 of the Inevitable Wealth podcast. I am Jackie P. And this is Julian. Julian, say hello to the folks.
Hello, everyone. Thank you for joining us this morning or evening, depending on when you are listening.
So there's been a lot going on in the news cycle, as there always is, Julian. And we figured we should take some time to talk about all the headlines you've been seeing. And we're going to try to keep this concise. So, some of these parts we'll touch on, and we might release some more long form explanation, especially things like, the big, beautiful bill that was just passed by Trump administration. But we wanted to sit down and have a conversation about what's going on over the last few months here and get into it. So let's kick it off. So let's talk about the market, right? The market has been pretty resilient, right? The S&P 500 then and the Nasdaq has been near and hitting all-time
hmm
highs. Julian, what for the folks who maybe have not been paying attention, can you explain a little bit of what's been going on with the market and where that optimism has been coming from?
Of course. I'd say it's been extremely resilient. It's a time where there's a lot of financial news going around. I think more than anything, it's not that people aren't paying attention. It's that when you watch the news, and I posted about it before on LinkedIn and spoken to a lot of different families we serve about it, they really lack optimism when they post anything new. Well, for example, the GDP growth as of late or earnings hitting all-time highs. It's always, when's the other shoe going to drop is kind of the connotation from the financial media. But markets have been great, right? We're at all-time highs, near all-time highs, depending on the day. The tax cuts, the overall AI uh, generation, right, effectively has been leading to better performance. And I think when you look at things overall, a diversified portfolio has outperformed the S&P 500, which we haven't seen in quite some time. Where a lot of the families we serve, because they hold international markets, which are up about 17%, they have done much better than the S&P, which is not expected, not guaranteed, right? Past performance not indicative of future results, but it's been a good year so far as we go through this, and a lot of it is about just continuing to be diversified, be disciplined, and keep things going forward. What would you say has had an impact on the market? Have you noted anything that you'd like to add? What comes to mind for you?
Yeah, I think you touched on it lightly about the diversified portfolio finally doing what it's always been intended to do from a theoretical perspective, because the rally is still a bit narrow, right? The concentration, there's a handful of those mega cap names that's been pushing the S&P, and
Mhm.
it's something I like to always note to folks who ask, or the families and businesses that we serve, that we don't want to get too locked up into sticking into those sectors of the market, right? Making sure that we are not chasing that trend and keeping like a balanced and measured perspective of the future, right? Because the infrastructure AI is booming.
Mhm.
But just like how we saw when DeepSeek came out and gave us a little bit of some uncertainty, right? You never know what's coming down the pipe. So always trying to be measured and making sure that we're not trying to chase that trend or risk being overexposed in one particular side of the market. But yeah.
Exactly. And it's one of those things where if you looked early in the year, tariffs were the big news. And it was, the sky's falling, right? What's going to happen? This is new. This is going to be lead to outrageous inflation. And there's always still time for a lot of this to work out, just like a lot of the COVID effects, COVID in 2020, we saw in 2023 and 2024. But so far, it hasn't led to substantial wage inflation. It hasn't led to substantial inflation across the board. GDP has been strong. A lot of it has been muted through negotiations. So I know it's a highly politicized topic, But when we really zoom out and just strictly look at the markets, it hasn't led to substantial volatility in a negative way, right? So markets are performing well. And then we haven't even gotten into potential rate cuts, which we'll talk about at the end, right? A little note to keep people listening. We'll talk about it at the end as well as we go through it. But much like you said, so much about this, even though it's a lot of mega caps doing the heavy lifting in the US and then international markets, a lot of what we look at is don't get greedy, right? Quite simply, and not overweighting, those high leverage tech positions, especially when things are already going so well for a lot of the families we serve.
Yeah, yeah, and then I think this is a good a segue into talking about a lot of the uncertainty was what that one big beautiful bill was going, if it was going to pass, if it wasn't. Now that it's passed, and whether you like the bill or not, one thing I enjoy is we know where we are and we know how we
Mhm.
can move forward with this information. So for those who don't know, back in July, basically the Trump administration signed into policy the TCJA that was passed in 2018, making a lot of
Mhm.
those tax policies permanent, right? So
Mhm.
tax brackets, standard deduction increases are permanent. So, Julie, not having the take here, but can you like walk through some of the things you see that might be enticing for some taxpayers, right? Which is all of us within the bill.
Absolutely. I'll rattle off a couple, and then you could take a couple as well. Most importantly, and impacts effectively everyone across the board, the tax brackets that were from the TCJA are permanent now. So effectively lower tax rates for most folks, a wide majority of folks, tax rates staying lower instead of going up, between 1 and 4 percentage points, which is certainly impactful. The standard deduction has increased. The SALT cap has increased. The temporary deductions they rolled out, for example, no tax on tips up to $25,000, no tax on overtime up to $25,000 for joint filers. You can write off your car loan interest on a new vehicle that is US assembled. So there's some nuance there. I would argue that one's not extremely impactful because when you're writing it off versus the cost of a new car versus your tax bracket, right? It's not a credit, it's a deduction. So important to note, don't get too aggressive there with a new
Mhm.
vehicle. The For lack of a better term, as we kind of go through this, right? They're calling them right now Trump accounts. They haven't rolled out what the official name would be, I guess, similar, maybe it would be that forever. But right now, a lot of that's still being worked out, right? Because they have to create the account type, similar to how they created Roth IRAs at one point, and roll out what that could look like. But those accounts can be extremely beneficial for newborns between 2025 and 2028. What would you add to that? What additional deductions and changes do you see? What comes to mind?
Yeah, and one thing I would note, excuse me, some of those deductions that were added, like the senior deduction,
Mhm.
and the deductions for tips and overtime, that only goes through 2028, what you mentioned.
Mhm.
But also just make sure you speak with a tax accountant and advisor, because there are still some parameters, right? You just can't deduct tips. There are some nuance, or you have to be reporting these tips, and you have to have a history of reporting tips. So folks out there, just make sure you understand the deeper way that it
Yeah.
affects you.
I think the ongoing joke is, well, I'll just have my employer pay me in tips, right? That's
Yeah,
just
exactly.
recurring
Yeah.
narrative. It doesn't quite work like
Yeah,
that.
yeah,
No
yeah,
such thing as a free lunch.
exactly.
Uh, what
Um,
did you see with the estate tax? What else comes to mind around
so,
there?
so the estate tax, and I think the business plan estate tax has been major, especially something we've been working with a lot of our
Mhm.
families in business. So the estate tax exemption that was temporarily brought up is now permanent. So it's currently at $15 million per person, or 30 million if you're married filing jointly, which is major,
Mhm.
because this is essentially going to save a lot of those high net worth families in estate taxes. Another is the the qualified small business exclusion, which is raised to 15 million. It is tiered benefits, right? So it's not across, it's across like 3 to 4 or 5 years, but
Hmm.
that's another major thing if you're a business owner. And for those folks in the real estate, the side hustlers and Airbnb, right? I'll call those guys out. The 100% bonus depreciation is also they increased that to I think $4 million cap. So
Hmm.
if you're not aware, when you buy an investment property, you can basically depreciate that value on your taxes. It's why a lot of folks who are in real estate enjoy real estate because of the tax benefits and things that they can take
Hmm.
advantage of. And now they're doing a 100% bonus depreciation year one,
The huge
uh,
benefit.
which is major. So I can imagine a lot of the bigger players out there who have the capital just to buy these properties outright, or for they're gonna save a ton on taxes, and probably I'd say grow even larger.
Yep.
Um,
And it's another reason not to buy property in an IRA, right? We
yeah.
constantly get questions about
Hmm.
self-directed IRAs. Hey, my accountant says I can do this. It all sounds good in theory. One, it's much harder to get a loan. Two, you have to have a substantial sum in there because you have to be able to buy the item in full, right? The property in full. And then three, all these great deductions and all these tax benefits, right? That come to mind, you cannot take advantage of because it's already within the shell. So, uh, just a little note out there because we do get probably one question a month about
Yeah,
self-directed IRAs with property,
yeah,
and it's usually someone they don't necessarily have $5 million in their IRA to buy a property, so it
yeah.
doesn't always make a lot of sense.
And I'd also like to just to point out the concentration risk. I
Hmm.
think if everyone had a ticker symbol on the front of their house right next to the numbers, they would see that the real estate is not more or less volatile than capital markets.
Hmm.
It's just that when you have real estate, it forces you to do what you're supposed to do with investments, which is
Hmm.
be patient, right? If you can panic sell your real estate when it pulled back, yeah, and again, I'm not against real estate investing. I have friends who are incredibly successful in real estate, but uh, if you put all your IRA in real estate, you are very, very concentrated in one sector. And the data
Hmm.
shows real estate doesn't keep up with just a well-diversified portfolio over the long term
Yeah,
anyway.
and I wouldn't even say just one sector, right? Because it's
Yeah,
the sector is real estate, but it might be real estate in Philadelphia, right? So it's
yeah,
even more concentrated where
yeah,
the tax implications of Sherelle Parker, or if you're in Indianapolis, right, the mayor there, wherever you are in the US, you're extremely concentrated to
yeah,
that geographic area. And you already have that through your job, right? Because if you're
yeah,
working, going to the office and there's a downturn in your local environment, right?
yeah,
Um, so it goes even a step further as far as
yeah,
that diversification,
yeah,
which can be good, right? Because it can lead to enhanced upside, but it can also lead to enhanced
yeah,
downside.
yeah.
So just something to think about.
Yeah.
Um,
So
I
yeah,
can
but
jump into the next one. You got anything
yeah,
else?
absolutely. Well, I was just gonna say the bill that is locked in, right? You should be talking with obviously your certified financial planner if you have one, and also your tax accountants because it's
Yes.
locked in a lot of those provisions. Especially, I think the SALT thing, I think we kind of passed over it, which is exciting. The the state and local taxes was like 10,000, which is pretty low if you lived in a high tax area like New Jersey or California, right? So yeah, so work with your CPAs and accountants and make sure that you're maximizing this new arena that we're in.
Exactly. Um, Absolutely. This is not tax advice, right? Little
Yeah,
compliance disclosure, not
yeah,
tax advice. Speak to an accountant, because, for example, with the SALT deduction, you do have to itemize, right? So a lot of
hmm,
folks think it's a free deduction, but nothing's free, right? So you may just be better served by the standard deduction, whatever, not tax advice. Um, Next segment,
yeah,
interest rates, right? So a lot of folks buying houses, looking at houses, looking at refinancing. I know I saw a quote for a mortgage at about 7% just last week, certainly much higher than it was when folks were getting 3 and an eighth. I think the lowest I heard over the past year. Um, someone in 2020 got a 2.6, which is
Yeah,
outrageous, right? That's
yeah.
amazing, compared to what we have now. So what have you been seeing? What has the research been saying? I know we speak to Wisdom Tree fairly often. What kind of
Yeah.
comes to mind for you as far as interest rates?
So for interest rates, it's for me, it's there's a dichotomy, right? One is we all want interest rate cuts, we want lower borrowing rates, but typically what that means is that the economy isn't doing well, right?
Right?
So,
Yeah. Two
so
sides of the coin.
yeah,
Everyone's lower interest rates, but it means job loss
yeah,
and risks and volatility in the market.
yeah,
If they cut it when it's too good, that's not good.
yeah, exactly. And the Fed is signaling that there will be rate cuts, but it doesn't seem like they might not be anytime soon, later this year, maybe early 2026. Um, but yeah, the jobless claims are steady, PMI are steady. Uh, there aren't these big red flags that are telling Jerome Powell and the rest of the Fed saying, "Hey, we need to cut rates." I wish, they say hindsight's 2020. We all should have went out and bought a house back in, speaking of 2020, right? With those, with those sub 3% interest rates. Um, but yeah, I think we have to be flexible when we're looking at what interest rates are doing, because
Mhm.
I think even the Fed has a history of not doing what they say they're going to do, because new information comes out, the parameters change. So yeah, I'm okay with not interest rates not being cut, because that means that the folks who are much smarter and wiser at reading the economy don't
Mhm.
see any, danger. I don't want to use the word danger, but they don't see any issues. So
Yeah.
I don't know. What
And
would be your
you
take?
gotta
Yeah.
save your ammunition. You gotta
Yeah.
save your ammunition. When there aren't substantial problems, when a lot of the families we serve are up 10% for the year. When we look at things and international markets and US markets are doing great in unison, it's not necessarily the time to start feeding the fire. You want to save it, right? So you can stay warm, throughout the cold winter. So you want to effectively save it. They always say they're data dependent, right? So they can turn on a whim. My expectation is they do, a quarter point cut maybe three times this year, right? That's sort of the data we're seeing. So bringing it down 0.75% from where it is now. But again, they are data dependent. So we'll see where jobless claims come in. They did have a couple big revisions over the past week, but it is all relatively normal what's been occurring up to this point, right? The only thing to keep an eye out for is inflation ticking up substantially, right? Not necessarily, if you were to pay attention on a day they report CPI, they will say, "Oh, inflation exceeded expectations," and it's 2.8 instead of 2.7. That's
Yeah.
not necessarily a huge difference, but effectively keeping an eye on things to see if it were to tick up for the foreseeable future, what does that look like? But
Yeah.
absolutely, data dependent. That's what we're looking for, and what that would lead to, I would say, is from a market perspective, a potential cycle from these mega cap companies to small cap companies. Because what these things really impact is the cost of borrowing. And when Apple needs to borrow, they get great terms, right? They have so much cash. When Berkshire Hathaway wants to borrow, they have so much cash. But when your small caps, right, your smaller companies want to borrow, they're paying 10, 11, 12%. And so if rates come down, that can certainly have an impact there and see them start to outperform the mega caps like we've seen as of late, or unlike we've seen as of late. Anything to add there, Jackie?
Yeah, I think one thing we should mention about just the not to get political, but I think one thing, in my opinion, is Powell is trying to really enforce the independence of the Fed in this decision making. And and I'm not saying this, but there's a lot of voices out in the world saying that, hey, maybe if he wasn't pressured by outside forces to cut rates, the rates would have been come earlier. Um, so yeah, it's something I think we should also think about as well when it comes to what is the policy going to be down the line. Um, yeah, just because it is a interesting, I think, back in a couple years ago where good news was bad news was good news.
Mhm.
We're almost something like that, where inflation needs to get better, and things need to get worse so they can see
Mhm.
that they need to cut interest rates. But if they hold steady, I think that's not bad either.
Exactly.
Yeah,
And he's only got a couple of months left, so he'll probably maintain. They'll promote someone new. I think Waller is the big name. That's a little bit more
yeah,
dovish, Chris
yeah,
Waller.
yeah,
But we'll see what happens next. There's always a man behind the curtain. They'll maintain independence. There will always be a degree of pressure, regardless, on them, right, to kind of carry the economy and make strong decisions. And we'll just keep going from where we are to the next
yeah,
step, right? Because there's always a new narrative.
yeah,
Um, what else is new? I saw we spoke about it, I think last year,
yeah.
effectively that 401ks may be opening up to alternative investments. So what does that look like? What does that mean for a lot of the families we serve, folks listening, and what are your takeaways, action items, etc.?
So there's good and bad as with everything. And correct me if I'm wrong, I believe that the executive order might have been signed. It might have been,
Yes.
yeah.
Yes.
So what are alternatives, right? For those who might understand, alternatives typically have been a stream of a type of investments that are beyond your typical capital markets, right? Beyond your stocks, mutual funds, or ETFs. So you look at things like cryptocurrency, uh, gold, private equity, private credit, right? These types of investments that up until very recently were really reserved for what someone would consider an accredited investor, someone sophisticated enough to understand the complexity of these investments. These types of investments would sometimes, but not always, but most of the time have higher fees, longer illiquidity, which basically means, if you have a stock, if you sell it today, you have the cash tomorrow, it settles. But these
Mhm.
types of investments sometimes can go 7 years, 10 years without access to your capital. So of course, with these, with these type of parameters, they were considered something that not every investor should have access to. So the executive order that was signed
Mhm.
was basically freeing up all of this capital in 401ks to be invested in these instruments.
Yes.
Um, my knee-jerk reaction is a smaller percentage of people will benefit from this than the greater, for a myriad of reasons. But I'm curious what your take is, Julian.
Two things. One, I misspoke, has not been signed yet. It's being deeply considered, whatever that means. But they are evaluating. I would expect it to be signed because of donors and things like that. But
Yeah,
two, I think this is bad news across the board. No, it will not have an impact on you if you don't buy these things in your 401k. But for those that go on to autopilot and don't really evaluate annually, like we do with a lot of the families we serve, you will end up in some of these vehicles because you'll be auto enrolled and they're not selling them to you because they are amazing, right? What happened over 2020 to, well, I would say 2018 to like 2024, 2023, is there was a lot of money pumped into these funds. And right now they have no exit liquidity, right? So they have no one to sell them to because they're valued so highly, and it's trillions of dollars effectively in these vehicles. So they're saying, all right, we have no one to sell them to, right? Apollo doesn't want it. Vista Equity Partners doesn't want it, right? They already all have their own funds. Let's just sell it to retail, right? Let's just pass it off, pass the buck to those guys. Um, so that's my expectation or interpretation of what's happening, is they're going to pass the buck and offload the investment to retail at a high markup. So it's something that if you want to buy it with intention, know what you're buying. Don't just buy a one size fits all alt fund that has real estate, mortgages, private credit, private equity in it, because you're not going to get good pricing. It's not going to be complementary to your portfolio. When we use alternatives, we use them for folks with over $2 million that need exposure to a sector that they don't naturally have exposure to, right? If they're in real estate, we're not going to buy a real estate fund. And so when you look at things this is not needed for the average mom and pop investor. And so that's my takeaway. It doesn't mean it's going to blow up or anything like that, but it does mean high fees, unknown fees, these most folks don't check. And then three, unknown investments. A lot of folks like it because it sounds nice, sounds hot, but not ideal. Is that too much?
No, I don't disagree with you at all. But I want to have I'm the serial optimist, so I want to say and this is very few percentage, very small percentage of people that this potentially would
Hmm.
make sense for. And the one downfall of these private these alternatives that we use for some of the families that we use are that they can be a high tax burden. So if someone was high net worth, they have money, they understand, the investment, right? If it's like a private equity or private credit, and are able to put it in a retirement account, that just might be a good tax efficient way to
Yeah.
have exposure.
Buy with intention.
Yeah. But again, that is my like the one use case, right?
Hmm.
But when we look back and look at scale about the average person in their 401k, right? I'm still competing with people and meeting people. I just spoke with a woman yesterday who is 10 years from retirement. She didn't even know she should be invested in her 401k. Her 401k was sitting
Hmm.
in cash for the last 20 years. And just like you said, you know, folks kind of put themselves in a good or bad place already with the limited options of basic, simple funds, and
Hmm.
adding this tier of private or alternatives where, yes, one of their say the potential for the return rate of return can be better over long term. It can also be far, far worse, right? So, um, I also agree with you, Julian. I don't particularly like it. I also think about why are they, just as you mentioned, why are they open this up for 401k? It's not like they're doing this for the betterment of people so they can do better and grow their money
Hmm.
better, right? It's a cash grab if I boil it down to the least amount of words as possible. So, um, yeah, be careful if you see alternatives available in your 401k over the next year or so, if this ever does get signed in. Um, you don't need to be in it just because it's an option, I guess is the best way to put it.
Yeah. And rules are good. There are
Yeah,
lanes on the highway. Stay in your
yeah,
lane. Don't get too aggressive. Don't go too fast.
yeah,
But if you're going into it just because, don't,
yeah,
quite simply.
yeah.
If you have the assets and are looking for something nuanced and have spoken to an investment advisor, a CPA, et cetera, great. But I would argue 330 million Americans, maybe applies to 500,000 of them.
Yeah, yes.
All right, next.
Yeah.
Now that we're
Moving
done
right
with
along.
my rant, all right, next we'll keep it brief. Action items. What should we be looking at in this market environment with the one big beautiful bill, or with rates coming down? What thoughts come to mind?
As always, we say this probably on every episode is blocking out the noise. As we saw early back, right, with Liberation Day, when the tariffs hit, the markets went bonkers. Then it came back. We had a record-breaking, was at 8 or 9% in one day, right? Uncertainty is born of volatility, and everything will always feel new. Everything will always feel uncertain, but you got to block out the noise. So stick to the discipline, right? It's a great time to rebalance. We rebalance for our families
Mhm.
pretty frequently, not because of fear, not because we're trying to make a call, but it's because it's this the discipline of the strategy. Um, right? What do you think about that, Julian? Like
No,
anything?
exactly.
Yeah,
Should be rebalancing. You'll be overweight in one space, specifically right now, maybe tech. And then when there's volatility, you will get hammered. So continue to rebalance. One thing you would have missed out on if you weren't rebalancing over the past couple of years, which a lot of folks did miss out on, is this significant international uptick, where international, again, up 17%. I love it. It's great. But If you weren't rebalancing, you missed that. If you aren't rebalancing now, you could miss a small cap rotation or a mid cap rotation. And you don't need to think about these things, right? You're not an investment advisor who's really focused on the different caps, different segments. But just intellectually, you should be taking a look and saying, are all my investments in United Health in 2020, right? It was up 45%. Right now it's down like 50 year to date, 40 year to date. So when you look at these things, what's hot now may not be what's hot in the future. And your goal isn't to outperform, it's to mitigate risk. It's to make sure that you don't blow up, for lack of a better word, lack of better terminology, right? Stay on the tracks, keep it going, lanes on the highway. Um, so keep an eye out for that. And then, don't bet on interest rate cuts. They may come, they may not, right? State independent. So quarter point, quarter point, quarter point, your life will not change all that much. So don't gamble everything on a move like that. It's everything
I
I
would
got.
also
What do you got?
I like to also add is just FOMO. We talk about that a lot, right? Fear of missing out. There's been some headlines about, cryptocurrency, stable coins getting some attention and regulation. Um, just like how we mentioned with the alternatives, I read a lot about crypto and it's hard for me to keep up with it, and how it really works. Don't let your neighbor or the guy at the gym talk about their great returns and for you to get into something you don't understand or doesn't fit for you, right?
Hmm.
Because if you're hearing about it now and it's doing well now, you're buying in when it's expensive. So
Hmm.
uh, simple is boring, but simple gets you there. And I think, if we can brag a bit, that's what gets our families to reaching their financial goals, right?
Hmm.
A simple disciplined
Yep.
process, not trying to be fancy, not trying to guess the flavor of the month, and and sticking to that, day in, day out.
Exactly. And everybody's playing a different game, right? The guy at the gym, or your neighbor, right? They have different goals than you. They have a different timeline. A lot of times it's a son or daughter explaining to their parents what crypto is. And right, if someone's 30 years old versus someone that is 60 and nearing retirement, there's different degree of risk that should be taken, right? Because if these things take off and continue to perform, we'll see that reflected across the market, where a lot of big institutions will get more efficient because of blockchain, because of all the AI technology. So you do partake in that, even though you may not own it directly.
Yeah.
All right, that's all I got. What do you anything parting thoughts?
No, it's beginning of August when we're recording this. We're I'm excited about fall. I don't know how you thought. I had pumpkin spice latte for the first time last year. I was avoiding it. So folks, if you're still traveling for the rest of the summer, safe travels, and enjoy this time before the school year starts and the chaos of the fall begins.
Mhm.
And as always, right, reach out if you have any questions.
Yeah, absolutely. Thanks for joining us. Fall's very exciting. Should be nice, nice and cool. We're getting there. I think it's a little early to address it though. It's August 5th. So maybe you jumped the gun a bit, gave somebody a little
Nah,
panic before
nah.
the back to school sales start.
No, no. Listen, I read it this morning. Home Depot put out their Halloween, big skeleton Halloween decoration, and as an unofficial sign of
Mm,
fall is coming. So
not early at all.
yeah, it's basically Punxsutawney Phil seeing his shadow or not, whichever one it is for spring.
Mm,
So all right,
perfect.
all right, folks. Well, thanks for listening. Have a good one.
All right. Thank you, everyone.